Yes friends, now let us focus on our another part of section 17 which deals with your proportionate ITC, proportionate credit. So friends, what you have to understand? You have to understand that there's something which is happening which is not allowing you to take the entire credit. Now what is that situation you have to understand? When you get full credit, when you get no credit, and when you get proportionate credit is the entire thing that you have to understand here. If at all you're talking about a scenario, if at all you're talking about a scenario where the goods or services are partly used for business purposes and partly used for other purposes, then there comes the concept of proportionate ITC. Or if you're talking about the goods or services are partly used for taxable supplies, which along with it will include always zero rated supplies. Why? Because zero rated supplies, though you don't pay output tax, you can get the credit. See, what is the normal understanding? You pay output tax, get the entire credit. You don't pay output tax, no credit. But for zero rated supply, even if you don't pay output tax, you get entire credit. So there are certain goods and services which are used for taxable supplies, including zero rated supplies. Also, they are partly used for exempt supplies. In that scenario, again you talk about proportionate ITC, taxable as well as exempt. So when you talk about certain goods or services used for business as well as personal purposes, proportionate ITC. When you talk about certain goods or services which are partly used for taxable supplies and partly for exempt supplies, proportionate credit. Friends, when you talk about certain goods or services which are used only and only for business purposes and only for taxable supplies, you get full credit. So you have to understand that how to segregate it. Now let us segregate the things and let us understand that how you are going to get the credit. If goods or services are exclusively used for business purposes and exclusively used for taxable supplies, get full credit. If goods or services are used for only personal purposes, no credit. If goods or services are used only and only for exempt supplies, no credit. So till here things are very simple. So fully used for business and taxable supplies, full credit. Exclusively used for only personal purposes, no credit. Exclusively used only for exempt supplies, no credit. So when that proportionate credit comes, only for certain goods or services which are used both for business and personal purposes, proportionate credit, or certain goods and services which are used for both taxable and exempt supplies, proportionate credit. And credit will be restricted only to that business portion or that taxable portion. Now how to find out that? For that you have a rule called as Rule 42. Rule 42 and Rule 43 are the two rules which talks about calculating proportionate ITC. Rule 42 talks about calculating proportionate ITC for inputs and input services. Whereas Rule 43 talks about proportionate ITC for capital goods. Friends, that inputs and input services which are used for both personal and business use as well as for taxable and exempt supplies, we call it as common inputs and common input services. The same is true for capital goods as well. So the focus is on common inputs and common input services. Now how to analyze that? We will make it quite simple. Supposing your entire credit is T, which is equal to 10 lakhs. Total credit is equal to 10 lakhs. Out of which few inputs and input services. Friends, the focus is only on inputs and input services in Rule 42. Few inputs and input services are used exclusively for exempt supplies. Exclusively, this is total credit. Exclusively for exempt supplies. T1, say it is say 1 lakh. Few inputs and input services are used exclusively for non-business purposes. Say 50,000. Right, few inputs and input services are used exclusively, are covered under section 17 subsection 5, that is block credit. That is block credit. Let us say it is another 50,000. Right. So when you talk about the total credit, you have to categorize that into two, first and second category. The first category will talk about exclusively for exempt supply, you don't get the credit. Exclusively for personal purposes, you don't get any credit. Block credit, section 75, you don't get credit. So all these three cases, you don't get any credit. You don't get any credit. The balance credit is called as common credit. We will call it as C1, common credit. Now what is common credit? 10 lakhs minus your 10 lakhs minus this entire thing, which is say 2 lakhs, because 2 lakhs you don't get credit. So your common credit is 8 lakhs. Your common credit is 8 lakhs. So for this common credit, friends, you will get the amount in your electronic credit ledger. So when you talk about this T1, T2, T3, which is exclusively for exempt supply, exclusively for personal use, exclusively covered under section 17(5) block credit. You don't get the credit, it will not hit electronic credit ledger. But this 8 lakhs will go and sit in your electronic credit ledger. But wait friends, this 8 lakhs does not contains entire credit. This says 8 lakhs has two portion. Now you have to segregate this 8 lakhs. 8 lakh has to be further divided into two parts. What is the part 1? Part 1 friends, you are talking about a scenario where you will get entire credit, say let us assume that part 1 is 5 lakhs exclusively for business purposes and taxable supply, exclusively for business purposes and taxable supply. This was say exclusively for exempt supply, or this was for personal purposes, and this is a blocked credit. Now you are talking about exclusively for business purposes and used for taxable supplies, which include zero rated supply, 5 lakhs. You should get full credit and you have got full credit. So this particular category, you should not have got the credit and you have not got the credit. 1 lakh plus 50,000 plus 50,000, you should not get the credit, you have not got the credit. 8 lakhs contains both full credit as well as proportionate credit. So this you should have got full credit and you have got full credit. This portion was no credit portion and you have not got credit. 2 lakhs is no credit portion, you should not get credit and you have not got credit. 5 lakhs represents full credit, you should have got full credit and you already availed full credit. Now balance 3 lakhs, 8 lakhs minus 5 lakhs. This balance 3 lakhs represents actually common inputs and common input sources. This actually represents common inputs and common input sources. You should have got only proportionate credit, but you have already got full credit. So this 8 lakhs is divided into two parts. This 8 lakhs now is divided into two parts, where you are talking about 5 lakhs full credit, you should have got full credit, you have got full credit in electronic credit ledger. 3 lakhs you should not have got full credit, but you have already got full credit. Which means that now you have to do some reversal. Now that reversal is D1 and D2. That reversal is your D1 and D2. D1 reversal is in relation to exempt supply. D2 reversal is in relation to your personal use, personal purposes. This D2 will not come every time. D2 will come only if the question is specifically asking. So that you have to remember. D1 will all come always. D2 will come only if the question is having such data. Now what is the D1 reversal? D1 reversal is equal to 3 lakhs, which is because this 3 lakhs you should not have got entire credit, but you have got entire credit. So now you are going to reverse something. 3 lakh multiplied by turnover of exempt supplies divided by adjusted total turnover. D2 is equal to 3 lakhs multiplied by 5%. Right, these two amount you have to reverse it. So these two cases you are going to now you have to just take the data and work it out. So you will see the turnover exempt supplies and you will see the total turnover. So D1 is equal to 3 lakhs multiplied by value of exempt supplies divided by adjusted total turnover. D2 is equal to 3 lakhs multiplied by 5%. Important point is D2 will not come always, it will come only if the question is specific about it. Right. Now this will be reversed from your ITC, which means that it will get reduced from your electronic credit ledger. So initially you have got 8 lakhs in your electronic credit ledger. Which is 5 lakhs you should have got full, you have got full. 3 lakhs you should not have got full, but you have got full. Out of which now you are going to reverse something from that 3 lakhs. 3 lakhs you should not have got full, but you have got full. So you are going to reverse something. One reversal is D1, which will come always. D2 will come only if the question is asking. D1 is in relation to reversal in relation to exempt supplies. D2 is in reversal is in relation to personal purposes. So D1 will come always. Reversal of ITC will be that. Right. That is the entire working which will be done. This will be done month on month basis. Friends, this is all about this is everything about your common inputs and input services as per your rule 42, and this is done month on month basis. Now wait, we are almost done with this rule 42, but there's one thing that you have to understand. What is that thing that you have to understand? Year end reconciliation you should do. You should work out the same thing year end as well. D1 and D2 reversal you should work out, which means that month on month reversal will be doing D1, D2, D1, D2. D2 will not come always, only if the question is asking, giving the data that there are certain inputs and input services which are used both for business and personal is only then D2 will come. Otherwise D2 will not come, only D1 will be there. So year end reconciliation you are required to do. Now friends, what are you going to do in year end reconciliation? Same formula that you have applied month on month, you will be applying year wise and again finding D1 and D2 reversal for now, not for month but for the whole financial year. Which means, supposing assume that month on month reversal which you have done, say month on month reversal you have done 50,000, 60,000, say 35,000, etc., etc. Month on month reversal you have done for 12 months. This month on month reversal comes to say 5 lakhs. This is monthly calculation. Year end check tells that the reversal should have been 6 lakhs. Now in that case, what you have to do? In a case where you have already done reversal of 5 lakhs, but year end check tells that you should have done reversal of 6 lakhs, you should reverse one more lakh. That extra 1 lakh will be paid along with interest from 1st of April of the succeeding financial year till the date of payment. So in this scenario, what will happen is you are going to reverse ITC of 1 more lakh along with interest at 18%, not right from the beginning. It will be from 1st of April of next financial year till the date of payment. This is one scenario. Another scenario, assume year end reversal comes to be 4,50,000. Same, some year end D1 and D2 comes to be 4,50,000. First you have to calculate month wise D1, D2 to find the total of the same. Then you have to check year end figure, which will be only one figure. If it is more than what you have reversed, do the extra reversal along with interest at 18% right from 1st April of next financial year till the date of payment. If it is less than what you have reversed, which means you should have done reversal of 4,50,000. You should have done reversal of 4,50,000. But you have already done reversal of 5 lakhs. You have already done reversal of 5 lakhs month on month. Now what you are required to do? Re-avail credit. Re-avail the ITC. Re-avail the credit. Whatever extra reversal you have done, you re-avail the ITC, but within the due date. What is that due date that they are trying to talk? They are telling that excess reversal, re-avail the credit before the month of September of next financial year. The time limit for re-availing that credit is September of next financial year. So that is all about this. Rule 42 year end check. Right. This normally doesn't comes in your exam question. They will stop at monthly reversal, but year end check will be there. That's everything about your rule 42. Now friends, let us focus on your rule 43. Now rule 43, what it is trying to tell? Rule 43 tells that now we are talking about reversal of credit on common capital goods. Reversal of credit on common capital goods. The best way to understand your rule 43 is taking this example. Right. So we'll make sure that you understand rule 43 entirely with the help of this example. Right. We'll make it things very simple. Now let us focus on this example step by step. You will understand the entire rule 43. Our revision of rule 43 will be totally over. Now during April 2020, Tata Limited purchases the following: capital goods A. Value is 10 lakh, GST is 50,000. Capital goods B. Value is 20 lakhs, GST is 1 lakh. We are focusing on GST. Capital goods C. Value is 30 lakhs, GST is 1,50,000. Now, capital goods A was exclusively used for exempt supply. B was exclusively used for taxable supplies. And C is used both for taxable supplies and exempt supplies. Now friends, you have to understand that just like we have worked for inputs and input services, have that understanding, but there will be small change here and there. What are the changes? We'll discuss. Now capital goods A, you can take full credit. Capital goods A, you can take full credit, and you're going to take full credit. Full credit you can take. So capital goods A, 50,000, you are going to take entire credit. Rather, sorry, capital goods A, you cannot take any credit because it is exclusively used for exempt supply. Beg your pardon, it was exclusively used for exempt supply. You cannot take no credit category because it is exclusively used for exempt supply, no credit, so it will not be credited to your electronic credit ledger. Capital goods B, you can take full credit because it was exclusively used for taxable supply. 1 lakh entirely will be credited to your electronic credit ledger, full amount. Even capital goods C, though it is a common capital goods where we are focusing on rule 43 is only for capital goods C. Though capital goods C, you should not take entire credit, but initially you will get the entire credit, full amount. Full amount you will get. Initially you will get the full amount. See, there is no problem with capital goods A and B. A, you cannot take credit, you are not taking the credit. B, you can take full credit, you have taken the full credit. Capital goods C, you can actually take only partial credit, but you have taken entire credit. So, initially you have taken entire credit. Now, what are you going to do? You are going to reverse it. Now, this reversal is a small difference between reversal that you do in your 42 and here. Here the reversal will be, again the basis will be 1,50,000. The basis will be 1,50,000. So, first you have to take this 1,50,000 divided by 60. There the 60 will not come. There it is the common credit multiplied by taxable exempt turnover divided by total turnover. Here it is common credit multiplied by exempt turnover divided by total turnover. But there is one more thing, multiplied by 1 divided by 60. So, first you have to take that divided by 60. You have to calculate monthly reversal. Monthly reversal that will happen. Monthly reversal will be 1,50,000 divided by 60. Because you are going to do that reversal for capital goods C not only in that month but for next 59 months also. This month and next 59 months. So, monthly reversal will be this 1,50,000 divided by 60. Then step 3. Now, this reversal is not the exact reversal that you are required to do because it is the basis is divided by 60. This will be common figure for the reversal. 1,50,000 divided by 60, which is 2,500. This is the common basis for reversal during this month and next 59 months. But reversal will not be 2,500. Reversal will be 2,500 multiplied by exempt turnover divided by total turnover. In this case, exempt turnover was given as 1 crore and total turnover is 1 crore plus 2 crores, that is 3 crores. So, you are going to do reversal. Actual reversal that will happen is 2,500 multiplied by 1 crore divided by 3 crores, that is TE that you are going to reverse. TM is the monthly basis that you are going to use. TM. T is the actual reversal that you will do. 2,500 the basis multiplied by exempt turnover to total turnover. Now, you may ask, what are the differences that you have in 42 and 43? The first difference is in capital goods, rule 43, you have this 1 divided by 60. 1,50,000 multiplied by 1 divided by 60, which is not there in input and input services. Second difference is in capital goods you don't have year end check, which is there in inputs and input services. Input and input services you have a year end check. In capital goods there is no year end check because you are going to do reversal not only for this month but also for the next 59 months. Third, when you talk about 42 that is all. When you talk about capital goods, you don't actually call it as reversal of ITC, you call it as addition to output tax liability. So, when you talk about rule 43, there are 3 differences, major differences that you can easily identify. Point number 1. Here you have 1 divided by 60, which is an extra element, right? What is that extra element? 1 divided by 60, which is not there for your inputs and input services. And when you talk about your second difference, in capital goods, you don't have a year end check that you have for your inputs and input services. Third, for your rule 43 capital goods, you call it as addition to output tax liability. You don't call it as reversal of ITC, you call it as addition to output tax liability. Whereas in 42 and 40 rule 42, that is inputs and input services, you call it as reversal of ITC. Right, these are the 3 important differences that you easily find it out in your calculation portion, so that it is easy for you to recollect. Now, if I were to explain in a very simple manner, I would have taken this example and completed it. I mean, this generally happens in a very normal situation. But wait, let us continue the example. Now, something happened in May. In May 2020, we are talking about May month. Tata Limited purchased the following capital goods. What are the following capital goods? We are talking about, say, capital goods D. GST 2 lakhs exclusively used for taxable supply, which means that you will get entire credit. Capital goods E. Capital goods E, which is GST is 2,50,000 common, which is used both for taxable supply and exempt supply. But wait, there is another point also. From May 2020, capital goods B will be used both for taxable supply and exempt supply. Capital goods B, which was earlier used only for taxable supplies, Now it will be used both for taxable and exempt supplies. That is a special point here. Now let us analyze what happens in May. So first focus will be only on D and E. Then we'll focus on B. First focus will be only on D and E. Now what will happen with D and E? So when you talk about D, capital goods D, 2 lakhs exclusively used for taxable supplies, no issues. Why? Full amount will be credited to electronic credit ledger. It is covered under now full category and you will get full credit. Why? It is used only and only for taxable supplies. Capital goods E, E, 2,50,000. Now that capital goods is used for both taxable as well as exempt supplies. So it is covered by common category. You should get only proportionate credit, but for the time being you will enjoy entire credit. For the time being you will enjoy entire credit. Next you are talking about that conversion. Now what is happening special is, there is a capital goods B which was initially used for only taxable supplies. Now it is used for both taxable and exempt supplies. Initially capital goods B was used only and only for taxable supplies. Now it is used both for taxable and exempt supplies, which means that from full category it is coming under common category, right? So 1 lakh, are you going to take credit again in the month of May? No. Why? Simple reason. For capital goods B, entire 1 lakh credit you have already enjoyed in the month of April. Now it is already credited, therefore nothing will happen in credit ledger. So capital goods B, 1 lakh credit portion you have already taken. You have already taken in the month of April, therefore nothing will happen in the month of May. Nothing will happen. Reversal will be coming, but nothing will happen in credit ledger. Right. Now, what is the total common credit, TC? What is the total? What is common credit? Common capital goods credit. What is the total common capital goods credit? The total common capital goods credit. Now, what are all the capital goods which are now common? Which are now used for both taxable and exempt purposes. One is capital goods C, April month. One is capital goods E. Other is capital goods B, which was earlier for taxable but now for both taxable and exempt. So capital goods C's credit is, so you have to add 3, capital goods C, capital goods E, capital goods B. Capital goods C credit is 1,50,000 if you can see the April month working. Capital goods E credit is 2,50,000 given in May month. Capital goods B credit is 1 lakh. Though you don't take the credit again in May, but the common credit will include even 1 lakh. So total is 5 lakhs. Right. So TC, credit of common capital goods, not only purchase in current month but also of previous month, including even conversion happening in current month. So it is capital goods C plus E plus B. B is very special because now it has been converted from taxable to it was earlier used only for taxable, now used for both taxable as well as exempt, which means that full category to common category it is there. So it is totally 5 lakhs. Now TM, what is the base for monthly reversal now? TC is total credit of common capital goods. TM is monthly credit, which is now 5 lakhs divided by 60, which is 8,333 if you use your calculator. But this is not a reversal. You are not going to reverse this amount, right? Because it is only monthly, 1 divided by 60. But what is the actual reversal? 8,333 TE. 8,333 multiplied by exempt turnover divided by total turnover. So in this May month, what was the exempt turnover? 50 lakhs. What was the total turnover? Exempt plus taxable 50 lakhs plus 3 crores, 3.5 crores. Now that will be added to output tax liability of May month. That will be added to output tax liability of May month, because for rule 43 you don't call it as reversal of ITC, you call it as addition to output tax liability, right? Next friends, they will continue the example. That's one more category that you have to understand, right? We have seen fully used for taxable, fully used for exempt, used both for taxable and exempt. We have also seen conversion from taxable to taxable and exempt. Now we have to see one more category, conversion from exempt to taxable and exempt. So that is the last thing that you have to see. Now we are talking about the month of June. In the month of June, Tata Limited purchased the following capital goods. Capital goods F, GST 3 lakhs, exclusively used for taxable supplies. Next we are talking about capital goods G, 3,50,000, exclusively used for exempt supply. Wait, one more special point is given. During June 20, capital goods A, which was excuse me, which was earlier used only and only for exempt supplies, now will be used for both taxable supplies and exempt supplies. So this we are talking about, this point friends, we are talking about exempt to taxable plus exempt, exempt to taxable plus exempt. In the previous point, capital goods B was covered by taxable to taxable plus exempt. Now it is exempt to taxable plus exempt. Reverse scenario. So one special thing will be there about capital goods A. Now wait, this is something that you have to understand because it has a special working. It is not like the previous month June, May. Now June will have certain special things. Step number 1. What will happen? Capital goods F, no worries. Entire 3 lakhs will be credited to electronic credit ledger. Capital goods F is used only for taxable supply. It should get full credit and it will be fully credited to electronic credit ledger. Capital goods G, 3,50,000. You should not get any credit and you will not going to get any credit because it is only used for exempt supply. You should not get credit and you are not going to get any credit. But wait, there's something special about capital goods A. Capital goods A earlier was used only for exempt supplies where you did not get any credit. So if you go back to the month of April and if you see capital goods A, you did not get any credit. Now suddenly it is used for both taxable and exempt supplies. So first thing that you have to understand, that will be a special working. What will be that special working? First thing that you have to understand, on capital goods A, you will get the entire credit. So entire 50,000, you will get the credit. But wait, getting entire credit is also not fully right because when you get the entire credit, you have to understand that at least for 2 months it was used for only exempt supplies. So there will be a reversal as well. What is that reversal? 50,000 multiplied by 5% multiplied by 1 quarter. So this will be again addition to output tax liability. This formula is actually ITC multiplied by 5% multiplied by number of calendar quarters. Now here number of calendar quarters is April, May, June. So it is only 1 calendar quarter. So what will happen for capital goods A is 2 things simultaneously. First, you will get entire 50,000 as added to your credit ledger. In the same month, you have to add something to your output tax liability for capital goods A. We are not even entered into common category. We are just discussing about capital goods A. First get entire credit 50,000 because you have not got earlier. Now you should not get entire credit because for some time it was used only for exempt supply. So you have to add something to your output tax liability, which is the ITC, which is 50,000 multiplied by 5% per quarter or part thereof. Quarter is always calendar quarter. In this example, it was used only for April, May, June. So it is only 1 quarter. This will be added to your output tax liability. Now friends, what are the common capital goods? What are the common capital goods? Now if you look at the entire question, common capital goods were capital goods C in April, capital goods E in May, capital goods B which was converted from taxable to common, and capital goods A which was converted from exempt to common. So there are totally 4 common capital goods. There are totally 4 common capital goods. C plus E, which were right from the beginning used for both taxable and exempt supplies. B, A, earlier they were used for taxable supply, later on they became common, or earlier they was used for exempt supply, later on they became common. So total common capital goods is 1,50,000 on capital goods C, 2,50,000 on capital goods E, 1 lakh on capital goods B, 50,000 on capital goods A, 5,50,000. So that is TC. These are the 4 common capital goods. Total credit on those 4 common capital goods. Right. And TM, the monthly proportion of those common capital goods is 5,50,000 divided by 60, which is 9,167. Right. But this is not the reversal. Actual addition to output tax liabilities TE, which is equal to TM plus TM multiplied by exempt turnover divided by total turnover. So this monthly base is 9,167 multiplied by, what is the exempt turnover? 50 lakhs. What is the total turnover of 50 lakhs plus 2 crores? So multiplied by 50 lakhs divided by 2.5 CR. This will be added to output tax liability in June. Now in June there will be 2 output tax liabilities. One will be in relation to capital goods A, added to output tax liability 2,500. Another will be in relation to all the common capital goods, which is 1,834, which will also be added to output tax liability. So this will be special. So in the month of June, 2 things will be added to output tax liability. One for normal case, common capital goods, which is TE. Other is only in relation to capital goods A, where initially you get entire credit 50,000, then you have to add it to output tax liability. So there are 2 addition to output tax liabilities in the month of June. So this, friends, you have to understand. So this is all about your common input services and common capital goods. Common input services is there under your rule 42. Common capital goods is there under your rule 43. Now certain special points here. General meaning. Now certain special points you have to understand that what is exempt turnover, what is total adjusted total turnover. So when you talk about exempt turnover, E, aggregate value of exempt supplies, and F, which is nothing but your total turnover, adjusted total turnover and state. Now when you talk about adjusted total turnover and state, it is very similar to your aggregate turnover. The only difference is whenever it is all about calculation, please remember that calculation is always based on state turnover, and when you talk about the concept, it is based on aggregate turnover, that is pan India turnover. So this is about calculation, it is based on state turnover, right? So what is the meaning of state turnover? The same thing as aggregate turnover, only difference is aggregate turnover is pan India and state turnover is for that particular state or union territory. So it means all taxable supplies and exempt supplies, including exports and interstate supplies. It excludes what? It excludes inward supplies, because turnover is all about outward supplies. It excludes inward supplies subject to RCM. It also excludes GST taxes. This is very similar to your aggregate turnover, exactly equal to aggregate turnover. The only difference is there is no pan India concept here, it is state wise. But small difference here. Here this turnover in state and union territory for the purpose of rule 42 and 43 will also exclude your excise, VAT and CST. So specific exclusion which is only in relation to 42-43. Definition of turnover in state or union territory is exactly equal to your aggregate turnover. What is that? It will include the taxable supply, exempt supply, zero rated supply, interstate supply, intrastate supply, everything. It will exclude two things. Inward supply subject to RCM because it is focusing on outward supply. And it will also exclude your GST taxes. Now, what is special about 42-43 calculation? When you take 43-43 calculation, then you have to make one more change in turnover in state or union territory. You have to remove even central excise duty, state excise duty, VAT and CST. So that is only specifically, only specifically for 42-43, not for other purposes. Now, what is meant by value of exempt supplies? General meaning. What is meant by value of exempt supplies? Value of exempt supplies generally means nil rated supplies. Normal meaning of exempt supplies, nil rated, 100% exempted, non-taxable. That is the normal meaning of value of exempt supplies as per section 2, clause 47. Nil rated, 100% exempted, and it includes non-taxable supply. Now specifically for the purpose of 42 and 43, specifically for the purpose of rule 42 and 43, there are certain specific inclusions only for the purpose of 42-43 and specific exclusions only for the purpose of 42-43. What are the specific inclusions? What is meant by specific inclusions? Right. Now, exempt supply will include something only for the purpose of 42-43. Exempt supply will exclude, value of exempt supply will include something for 42-43. Value of exempt supply will exclude something only for the purpose of 42-43. What it will include? It will include supplies where recipient is liable to pay under RCM. You are talking about not inward supply, you are talking about outward supply. First focus on turnover, always focuses on outward supply. You are not paying tax, but your customer will pay tax under RCM. Obviously, it is your turnover. No doubt that it is your turnover because it is your outward supply. You are not paying tax. Your recipient will pay tax under RCM. But if it is your turnover, will it be included in exempt turnover? Technically, it is not exempt, but for the purpose of 42-43, it is included in exempt turnover. Why? I am not going to pay tax. So technically, if I am making an outward supply to you and it is taxable under RCM, you are going to pay tax. So it is not your turnover, it is my turnover. It is very clear, it is my turnover. Now, is it my exempt value of exempt supplies? Yes. For the purpose of 42-43, it is value of exempt supplies. Why? I am not, for me it is as good as exempt. Though technically it is not exempt, for me it is as good as exempt because I am not going to pay tax. And next, transaction and securities. Securities is neither goods nor services, but for the purpose of 42 and 43, value of exempt supplies will include transaction and securities, not the entire value, only 1% of sale value of securities. So if I am selling say 1 crore, value of exempt supplies will include only 1% of sale value of securities. So it will not be 1 crore, it will be taken as only 1 lakh. So if my sale in securities is 1 crore, value of exempt supplies will not be 1 crore, it will be 1 crore multiplied by 1%, which is 1 lakh. Land and building, again it is not at all supply, but for the purpose of sale of land and building is not at all supply, schedule 3, but for the purposes of 42, 43 it will be included in value of exempt supplies. What value? Stamp duty value. Stamp duty value. It will not include any other schedule 3, only this particular value of land and building will be included. These are all specific inclusions. Why? They are not technically exempt, but for the purpose of 42, 43, treat them as exempt, add it in exempt value of exempt supplies, increase the numerator so that addition, reversal of ITC for 42 or addition to output tax liability for 43 is more. Now, what are the specific exclusions? Specific exclusions are, you are talking about taxes, which was even excluded from your turnover in state. Central excise duty, state excise duty, VAT and CST. Though they are actually included in turnover, but for the purpose of 42, 43, these taxes will be removed. Central excise duty, state excise duty, VAT and CST. Interest and discount, other than banks. For banks, interest and discounts is actually technically exempt. For banks, it is technically exempt even for the purpose of 42, 43, it is treated as exempt so that reversal can be done for banks. But for others, though technically interest income on loans and deposits, technically it is exempt, but it will not be taken as exempt supplies. Why? They don't want reversal. Now, why they have said for other than banks? For banks, interest income is one of the major income which requires reversal. So, for banks, interest income is technically exempt and it will be included in the value of exempt supplies. Also, no change. For other than banks, for normal companies where interest income is side income, small income, side income, technically it is exempt, but it will not be included in value of exempt supplies. Next, you are talking about transportation of goods by vessel from India to outside India. Technically it is exempt. When you are transporting goods from vessel from India to outside India, technically it is exempt, but they don't want reversal. How to not do reversal? They tell that it don't include in value of exempt supplies. So technically when the goods are being transported in vessel from India to outside India, technically there is an exemption, but they don't want reversal. How they enable that? How they do this? They tell that technically it is exempt, but will not be including in value of exempt supplies. Right. Now, if you see the left hand side, specific inclusions, technically they were not exempt. 3 cases, they were not exempt but included in value of exempt supplies. Your outward supply under RCM, technically not exempt but included. Securities, technically not exempt, technically not goods services but included in value of exempt supplies, only 1%. Sale of land building, technically it is not at all supply but included in value of exempt supplies, stamp duty value. Right. Likewise, 3 are the cases where you remove from the value of exempt supplies. You don't include central excise duty, state excise duty, VAT, CST. Interest income for banks, technically it is exempt, include in value of exempt supplies. For other than banks, it is a small income. Technically though it is exempt, but don't include in value of exempt supplies, which means that no need of reversal. And likewise, when you talk about transportation of goods in a vessel from India to outside India, technically it is exempt, but they don't want reversal for the shipping companies. So it is not included in value of exempt supplies. That is all about your, this is common for both 42 and 43. What will be there in value of exempt supplies and what will be there in turnover in state. Now friends, as discussed initially, for banks, that is banking sector, banking company, financial institutions, non-banking financial companies, they have one more option of going for simple reversal instead of complicated rule 42 and complicated rule 43. They can go for a simple option called as rule 38. So when you talk about banking companies, financial institution and non-banking financial companies, they can opt for 42, 43 for reversal. Obviously, banks will have reversal, common reversal. Why? Banks' major income is interest income, which is exempt. Other income, processing charges, documentation charges, NEFT charges, RTG charges, other small charges, they are all taxable. So banks will always have proportional IDC. Either they can opt for 42, 43 or they can think of rule 38. Rule 38 is very simple for them, very simple calculation. When it is rule 38, it is for not only for inputs and input services but also for capital goods. 42 is separately for inputs and input services and 43 is for capital goods. But if banks goes for rule 38, no differentiation now. It is for everything, for inputs, input services as well as for capital goods. Right. So banks, what they can do? Option 1, go for a regular scheme 42, 43. Option 2, go for a very simple rule, that is rule 38. How it is very simple? It is simplest to the core. How? If it is block category, if there are certain credits which is under block category or non-business purposes, you cannot get credit even in 42, 43. Here also there is no credit, 0 credit. But if at all you are talking about branch to branch transfer, one branch of a bank giving the services to another branch of a same bank, then you can take 100% credit. So you divide this entire credit of banks into 3 for rule 38. How? Blocked, no credit. Branch to branch, distinct persons. One branch of the bank to another branch of the same bank, distinct persons, get full credit if that is your inward supplies. And balance portion, third B, get 50% credit. A very simple calculation. Let us see one example of this rule 38. If at all there is an inward supply where it is blocked or non-business purposes, 2000 is the GST portion. If it is blocked or non-business purposes, no credit, 0 rupees credit. If it is branch to branch, there is distinct person, branch to branch, then it is full credit, 100%. Taxes 1000 on inward supply, you can take 100% credit. Balance, when I am talking about balance, you are talking about other input services and capital goods. Balance, 3 B's, blocked 0%. Branch to branch 100%, balance 50%. If the GST on the balance is 7000, you can get 50%, 3500. That is total is 4500 credit you can get. And one important point that you have to remember is, once you opt, you have to opt once in a year. So once you go for rule 38, once option once exercised, cannot be withdrawn for the remaining of the financial year. If banks are deciding to go for rule 38, in between they cannot go back to 42, 43. If they have decided that they want to go for rule 38, till the year end they have to be under rule 38. They cannot go back to 42, 43. Next year they can again, go back to 42, 43. So that they can do. That is all about special rule for proportionate IDC for banks. Either they can go for normal 42, 43 or they can go for special rule 38. Very simple. 3 B's, blocked, branch to branch and balance. Blocked 0%, branch to branch 100%, balance 50%. For all the 3 categories, inputs, input services as well as capital goods. That's all about your proportionate ITC.